I'm Caroline Hyde in London. This is the best of Bloomberg Technology, where we bring you all our top interviews from this week in tech. Coming up, a change of ownership in the cards for Britain's largest payment processor. We'll analyse US rival Vantiv's $10 billion deal to buy WorldPay. Plus, Alibaba enters the ring as the fight to dominate the smart speaker market intensifies. How the Chinese Titan's Genie stacks up against its rivals. And just as Tesla's Model 3 prepares to hit the road, a speed bump for the electric car giant. Why Tesla's sales shifted down a gear. But first to our lead, a massive deal in the digital payment space this week. Vantiv has agreed to buy British company WorldPay for $9.9 billion. And this comes after JP Morgan also showed interest, but ultimately backed away from the takeover offer. Vantiv, the US credit card processor, hopes to gain greater exposure to e-commerce retailers and small businesses through this acquisition. Bloomberg's editor-at-large Corey Johnson and Martin Mignot, his partner at Index Ventures, who has nearly 24 fintech firms in the portfolio, joined us for a reaction to the deal.
Vantiv's a fascinating company. It's based in a little suburb outside of Cincinnati, Ohio. Why Cincinnati, Ohio, for the head of global payments business? Well, what's interesting, it's a spinoff from the Fifth Third Bank, which sort of tells you sort of the history of this business of payment transactions. And what's really happening here, the way this business works, is when you go into a store and you use your credit card, of course, the credit, they find out if you've got the money in your bank account, and then they come back, whether it's debit or credit, and come back and pay the merchant, approve the credit or not. But there are a number of steps that happen behind the scenes. And that business, with each of those steps, takes a different chunk. So as you get the sort of verification from the merchant, and then the movement of the money between the merchant and the bank, and then the verification at the merchant side, as you go through each of these steps, there's a little bit of money taken each part of the way, and it results in billions of dollars. But what's happened is the world's movement of commerce has gone from physical stores to online, is the payment infrastructure, and the companies servicing those businesses have changed as well. And that's why you see Vantiv making this move, because they want to take advantage of the things happening online because they've done so well already offline.
Let's talk to a man who knows about the online presence, because Index Ventures has one of the biggest fintech portfolios out there, certainly in Europe. Is it all about the graduation of payments to online, to omni-channel as well? Is this the move?
Yeah, I think that's a big part of this story. Obviously, global payment processing, as we see, is a big market, and it's still growing very fast as we move from cash to card and from offline to online. I think the WorldPay story is very much part of that move. The WorldPay is very well exposed to online. About 40% of the transaction is online. They were actually the first payment processor for an e-commerce website in the UK in 1994. So it's very much part of that DNA. And they also have a very global presence in Europe and in Asia. And I think that's part of the story that's attractive to Vantiv, which has been mostly focused on more traditional brick and mortar retailers, which have been under attack against more kind of online players. And so I think WorldPay is one way to do that. It's a trend we have seen in some of our companies. I think the main one being Adyen, which is a company based in Holland, but with a very global footprint, which is very much playing on the same strengths of a new infrastructure stack, a global footprint, and offering an omni-channel, offering POS and offline and online and mobile as well. So that's been I think that's been very, very important to it. That we've seen that.
Corey, interesting there that, of course, this is the key move, and we're hearing of a portfolio company of Index Ventures there. What about other M&A in the sector? Because it has been hot, and interestingly, it wasn't the only suitor to begin with. JP Morgan was looking in, but perhaps backed away.
Well, let's talk about two of those. So first of all, there have been a number of acquisitions in this area over the last few years where you've seen the traditional companies that have had such a great business dealing with bricks and mortar retail wanting to have more exposure to e-commerce. So you saw Heartland Payment acquired by Global Pay. You saw First Data make a deal for Card Connect for nearly $1 billion, and of course a deal today for nearly $10 billion. And I think what's at play here too, let us not forget the very specific action that Amazon took in going after Whole Foods, if that acquisition is to come through. Vantiv shares actually dropped on that acquisition. Whole Foods uses Vantiv to process their payments, and although they're not even mentioned in the annual report of Vantiv, you saw the shares drop about 4% on the day of the announcement of that deal with the expectation of what if Amazon said, hey, we're going to stick with our existing payment structure, get rid of Vantiv, which Whole Foods is using, and go to use our payments processor, which is none other than JP Morgan. So the competitive space here is quite alive here, and you can see that with the M&A going on, with the old line payment processing companies trying to buy the new line companies, but also the notion that the new line e-commerce companies are sort of kingmakers, particularly none other than Amazon.
Amazon, the kingmaker. Martin, interesting, we saw another deal in Europe, Nets, which is a Danish company, payments company, saying it was being eyed up seemingly by American VCs at the moment. But what about the Adyen's, the iZettls, the company you have in your portfolio? Is your view that M&A might be the exit route, or do you want these companies to remain standalone?
I think we'd like for these companies to fulfill their potential and be as big as they can be. And we believe Europe can create these $10 billion plus companies that can be standalone, can become public, IPO at some point, because they, some of them have a technological advantage, they have a very large footprint, and they really don't need a backer to go all the way. And that's been the pitch from Index from the get-go. That's very much what we are focusing on.
That was Bloomberg's Corey Johnson and Martin Mignon of Index Ventures. Meanwhile, Facebook could now be the next target for European antitrust watchdogs. Germany's Federal Cartel Office is examining whether Facebook essentially takes advantage of its popularity by pushing users into agreeing to terms and conditions that they might not understand. We discussed what's next for the European regulators with James Chuckmark, he's analyst with Monness Crespi Hart, plus Eileen Burbidge, partner at Passion Capital, and Bloomberg technology editor Alistair Barr.
Privacy is a lot more important in Europe, especially to regulators, and there are a lot more rules and regulations in that region than in the US. But this really combines antitrust and privacy in the one charge here. And basically, they're saying that if you want to get on a social network, Facebook's probably really your only choice in the Western world, and so that dominance and that dominance over data is basically forcing anyone who wants to do that to sign up to all these terms and conditions.
And James, here the debate commences, because of course you're saying sometimes scale and size is good for the consumer, but sometimes here it seems as though the German antitrust authorities are feeling it's making Facebook with its 2 billion user group a bit too pushy. Where this investigation was announced back in March, does it mean anything for the company from your perspective?
Yeah, I mean, at this point, what's happening over there with Margaret Bettinger in charge, I think anything can go right now. I mean, the biggest ever fine levied on Google, who's to say that they won't crack down on Facebook? And at the same time, you're hearing her encourage other companies to sue Google. So, I mean, anything can happen, I think, with Facebook as well. But it's interesting, to go after the privacy angle. So, I mean, right now, I'm just not. It's tough to say. I think it's a wild card out there.
Eileen, when you're looking at from sat here in London, this is actually a German antitrust authority looking at Facebook. Yes, we had the European Commission also looking quite strictly on Google and now saying, hey, maybe time for others to start suing here. Does it need to? Does it affect Facebook? Because the fines actually don't matter, but it's whether they change these companies' ways of doing business.
No, I think you're absolutely right. So I'm not sure that the monetary value of these fines, even if they're the largest in history, actually make a difference for the companies themselves. But I do think one goal of the regulator is to signal, and what I think it does do is signal to the rest of the market that there is a watchdog, that there is somebody that's paying attention, that there's somebody who's trying to preserve competition and trying to preserve sort of users' privacy or, what's in the benefit for consumers. And so I think a lot of it is signaling and a lot of it is perception. The numbers, whether it's 2 billion, 3 billion, 20 billion, what's really going to make a dent or make, a company care is really kind of arbitrary. But the point is that, the industry and the sector knows that small companies trying to come up might have a chance. Don't give up. Don't think that you can't compete. Don't think that there isn't a level playing field or that it can't be re-leveled even later.
Alistair, talk to us about how the tech giants are interpreting Margaret Vestager Vestager in the European Commission, but also the German antitrust authorities who are working on Facebook here at the moment. Do they feel got at, or do they really understand that actually this is about increasing competition?
I think they partly feel got at, to be honest. The Facebook case in particular is a real. In the US, some people consider it to be a real overstretch, taking an antitrust argument, which understandably in Europe is a little different than the US, but taking that and applying it to privacy specifically is quite a large leap. On the Google side last week, there was kind of an air of resignation with the company that had been fighting this for about 7 years, and they do say they're considering an appeal, but the comments that they put out this time versus about a year ago were a lot less combative. So I think there's an air of resignation, certainly, especially when it comes to more pure antitrust cases like the one about Google Shopping.
And James, I just want to get your thought as someone who's therefore looking at potential value case for these companies. You rate Facebook. Does an antitrust investigation such as this make you worried about your price targets for these sorts of companies or not?
Not yet. I mean, last week we put a note out on Google saying this is overreach, so I agree with that. Privacy even more so with Facebook. You know, I always joke around saying, you know, if you don't like the privacy rules, don't accept them, but then you can't use the service. You know, that's what we do here all the time. But ultimately, what I'm most interested in is I'll worry if we see inaction, I think, from the United States. If we're in a position where we see a pattern of going after harder and harder and potentially trying to change the way these companies do business, and there's absolutely no recourse or any response from the United States government for that, I think at that point.
So, James, do you think this is an out-and-out negative? You think that the European regulators completely overstepping the mark here? You don't think that there's any reason why they should be trying to level these sorts of accusations at Facebook and Google?
I think they're picking the wrong battles. I think you can make the case that all these companies have done something wrong at one point or another. But I think the battles that they're citing and what they're trying to win with the vertical search, with Google, well, Google's done it for a lot worse. You know, when they scraped Yelp content and use it as their own. You know, that's a lot worse than what the EU regulators are going after. So what I'd like to see is what the U.S. response is, and based off of that, it would affect my ratings and targets. But as of now, I think I agree with Eileen. It's more signaling than anything else.
That was Alistair Barr, Bloomberg Technology Editor, Eileen Burbidge with Passion Capital, and Maness Crespi Hart analyst James Chudmark. Now, coming up, we'll explore the VC funding environment outside of Silicon Valley with Frederick Court of Felix Capital, who just raised $150 million. This is Bloomberg. London appears to be defending its title as Europe's tech capital. Now, that's according to London and Partners, the promotional agency of the city. Venture capital firm drove more than $2.3 billion into the city's technology sector since last year's Brexit vote, outpacing other European cities, including Dublin, Berlin and Amsterdam. One firm in on the action is Felix Capital, which just announced it's raising $150 million in its second funding round. Based in London, the firm backed some of the city's biggest successes, including Deliveroo and Farfetch. Now, Felix Capital founder and managing partner Frederick Court joined us to discuss the current landscape.
No, it's funny because clearly when we started 2 years ago, that was a big plus and there was no question about it, especially with our positioning around the creative class, London being such a brilliant example of technology and creativity living together. And 2 years in post-Brexit, clearly there were some questions. It hasn't stopped investors from backing us, but the question going forward was more, okay, what kind of opportunities are you going to be able to find in London. Based on the way we work, we tend to go after opportunities based on when they are. We don't expect to do everything just in our home turf in London. So I first met José Neves from Farfetch in Portugal, where he started this company which has become a global platform for fashion and luxury. So our job is to go to find the opportunities and then convince the entrepreneurs to work with us, irrespective of location.
What are you focusing on with this second fund? Where do you see the opportunities lying for you that make it distinct?
Yeah. The second fund is very much the validation of our original thesis a couple of years ago. It's still very early in the Felix journey. When we invest, we back companies for the very long term. It takes 5, 7, 10 years to build a company. So we are very much humbled by the interest from the investors. But the premise behind Felix is that we believe that there is an opportunity to have a venture firm that focused on digital lifestyle. By this we mean the emergence of new digital-first brands led by founders, which are impacting the way we live our life, the way we are inspired in different lifestyle segments, from fashion to beauty to food to well-being. Everything is changing through digital, and so we are looking for those founders who have got a sense of what people want, who are building communities in a very authentic, organic way, and where we can help them build a business.
You're going to be writing checks for, is it $2 to $5 million? What sort of level do you see yourself going in at now? Because that's far bigger than a seed round? Is it Series A? Is it Series B? These numbers keep getting bigger each time.
That's true. That's why we want to be a flexible investor. We are not dogmatic on we want to be the first investor. We want to own so much of the company. We want to back the best founders in the segments we believe in, where we feel we have an angle and where we can see a very big opportunity.
How do you find those founders? How are you seeking them out?
It's both an art and a science. So we've got our tools. We use data. We look at signals. I mean, these days using social media, you can track things. You can measure customer love looking at number of likes on Instagram, on Twitter, and that kind of things. But at the same time, we are very founder-centric. So while we look at data, we like to see passion, we like to see emotion between consumers and a certain product, a service, or a brand. So we combine both art and science, and eventually our business is always about making decisions on partial data. It's never black and white, it's always gray, so you need conviction.
I know you're not naming who your investors were. Last time it was the likes of Xavier Niel, it was Unilever. Is it institutional money? Is it global money?
Look, we are a startup in venture capital. The bar to back us 2 years ago when we launched our first fund was very high. Even to our surprise, the investor base for the first fund was very institutional. People who understand the venture business, who have opportunities to invest across the US, in Asia, in China, and chose to back Felix because they felt we were offering something different, something they did not have in their portfolio.
Coming up, there have been a slew of tech IPOs in 2017 as the US market returns to form. We take a look at how they're faring and measure the outlook for the next crop of tech startups waiting to take the plunge. And Alibaba is out with a new smart speaker to compete with the likes of Amazon and Google. Who else is in the race to own your home? We'll discuss next. This is Bloomberg. Now, initial public offerings are ramping up. In the US, IPO activity is up 243% compared with the same period in 2016. Globally, it's risen 96%, so almost doubling. The news comes on the heels of Blue Apron's lackluster trading debut last week and the more successful listing for Berlin-based Delivery Hero on the Frankfurt Stock Exchange. So what does this mixed bag spell for the IPO outlook for the remainder of the year? We asked Eileen Burbidge, partner at Passion Capital, and Maness Crosby Hart analyst James Chogmark.
It does give me a lot of encouragement, and I think that as we've seen with other types of things or swings in the market, in Europe we're a little bit more insulated from maybe increased valuations, but then also decreases as well. And I think when companies have gone public or when they have listed, they've already been through a little maybe extra rigor because there's not been this enthusiasm, there's unchecked, unbridled enthusiasm that we see in the States. And so, for instance, even last year, even though numbers were down in terms of listings, we had cybersecurity offerings, we had fintech offerings that were more more resilient than listings of those peers in New York, for example, or in the States. And so, yes, I do think it bodes well. I think that we're going to see a lot more maybe coming from financial services. I think there will be other sectors. As I was saying earlier, I think maybe not so much e-commerce, not so much delivery companies anymore, but we're going to start to see other sectors that are going to come to the public markets.
Interesting. And James, your take from perhaps the slightly more meagre Blue Apron, has that shaken the rest of the IPO market, or do they look across the pond and see how it's faring in Germany and just think maybe Blue Apron's a one-off?
Yeah, I think I'm a little more pessimistic than Eileen. But I do agree in the sense that there are many sectors like the financials, like the software perhaps, that are definitely more conducive to IPOs. Because yes, it's up this year, but at the same time we were below where we were just a couple of years ago. And the industries that are hard, like the one Eileen Mills is mentioning with the high customer acquisition costs, I think those are going to be facing greater and greater scrutiny. But I think what's really going to be a test is Spotify here, because as you look into it, are they conceivably going to go direct? Is the game going to change? And these are things that we don't know yet.
Yeah, Eileen, talk about the game changer, because we saw Snap change the game to a certain extent. It's another company that James analyses, that they changed the game in terms of keeping all power with the CEO and the CTO. Then we're seeing game changing with Spotify, perhaps not raising any more money, but just having to come to the market. What are you seeing from companies coming through and how they're altering?
I think what's interesting is this next generation of companies, and it really probably started with Google when they had a unique sort of tried to do an auction listing when they came to market, and then of course Zuckerberg when he brought Facebook and maintained all the control there. I think what we're seeing is there's a huge appetite from the markets for really solid, tech companies that have fundamentals, that people are clearly willing to concede other measures in what's typically plagued or hampered publicly listed companies in order to get value in those businesses. I don't know that Spotify is going to be able to pull it off, but I think, for instance, if Dropbox comes to market, and it was said today that they're probably starting to look at underwriters, they'll probably try and do something which gives them an advantage or gives them an incentive to list other than just raising money, because we're seeing, like the likes of Uber and other companies, otherwise they'll just continue to raise that money on private markets.
So what sort of advantage could they ask for?
I mean, I definitely think control is going to be a big thing, probably preservation of their status, liquidity options, preference rights there, but also just how much information rights they might have to yield, how much they might have to disclose in advance of the listing and then post-listing, if they can stay within, of course, SEC or other regulator rules, whether or not they have to be quite as transparent. Maybe they do a few tweets and they sort of share social media without having to, digest through hundreds and hundreds of pages of disclosures.
James, how hard does that make your job? I mean, you had to sift through Snap ahead of its listing. Of course, you're a man who came out with a buy rating on it almost before anyone else was out the gate. But what do you see when you're looking at the rules of the game changing, and how hard does it make to value these companies?
I'll tell you, I definitely, if I was at a private company, I would not want to go public. Just based on everything we've seen. Look, it's not easy, but at the end of the day, I don't really have to analyze companies that are private. I just need anecdotes and just kind of information flow in order to better assess the public companies, and that comes from relationships and so forth. So it doesn't really change my life all that much.
Are you looking for a Dropbox this year? Can you give us any sort of names that you think will be coming to the US market?
I mean, we know that Redfin is looking to come into the market, but obviously the one, and there could be some others, but at the same time, the one that I'm keeping my eye on the most is Spotify.
Now, a new forecast says electric cars will outsell fossil fuel-powered vehicles by 2040. That's faster than previously estimated. According to Bloomberg New Energy Finance, battery prices will plunge, turning the global auto industry upside down. That also will signal economic turmoil for oil-exporting countries. Now, coming up, more tech employees are speaking out against sexual harassment. How tech firms and startups are planning to combat this issue. And a reminder that all episodes of Bloomberg Technology are live streaming on Twitter. Check us out as @Bloomberg Tech TV. Weekdays, 5 p.m. in New York, 2 p.m. San Francisco, 10 p.m. here in London. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Caroline Hyde in London. Now, the competition in digital speaker assistants is getting more intense. Chinese e-commerce giant Alibaba has unveiled an Amazon Echo-like device named Tmall Genie X1. Fellow Chinese internet giant Tencent and South Korean company Samsung each prepared to develop their own AI-powered speakers, we understand. Now, we spoke with Bloomberg's consumer tech reporter Mark Gurman and Martin Mignot, his partner at Index Ventures, on the growing artificial intelligence landscape entering your home.
The interesting thing is only for the first, like you said, trial, 1,000 orders. I'm curious to see how high the price goes once they pass that 1,000, or even if there's going to be more than 1,000 people who are rushing to buy it. I assume there will be, given how big Alibaba's spread is across Asia. It's an interesting time for the digital speakers. I think this year, 2017, has really become the year of the digital speaker.
And everyone wants in. Samsung wants in, Tencent wants in, Baidu wants in. And how does it compare, therefore, with the landscape? Why are we seeing this drive to own the home at the moment? What do these companies want within their ecosystem?
Right. So you saw Amazon and Google jump in last year with updates to the Echo line, lots of new Alexa devices like the Tap and the Dot, Google with its home product that it launched last fall. And now the Echo Show, a new Echo with the screen, and they have the Echo Look as well. Part of the same family. It's more of a a style guide for your wardrobe. Now Apple, last month, they announced the HomePod for $350. Now you have all these players, like you said, in China, from Tencent to Alibaba, and South Korea, Samsung trying to jump in. So why do they want these? Well, let's start with Apple. The HomePod really takes advantage of Apple Music and Siri and HomeKit and Apple's home-based services and other streaming services where they're trying to make the bulk of their money in the future as hardware sales remain steady or slow down in some categories. It's important because people really want smart speakers. You see the demand for Alexa. You see the demand for Amazon and Google's home speaker products. If Apple doesn't create their own, or if these other players don't create their own, people will start buying the Amazon product. And then they might really like Alexa, and they're going to say, hey, maybe I should get some more Amazon products. Maybe I should subscribe to Amazon Prime Music and Prime Video instead of Apple Music and iTunes, and buy the Amazon Fire TV instead of an Apple TV. So we're starting to see this pace of people wanting to use those devices. And if Apple doesn't create their own, if these other players don't create their own, they risk losing other product lines to other companies.
Let's get the VC take now, because, Martin, when you see this rush for AI, I mean, you were saying how driverless cars was like the hottest investment over the last 12 months. Is AI really the hottest investment too? And is there enough talent to go around, let alone enough money?
Yeah, I think it has been a very hot area, but I think while on the driverless car, we have seen a lot of startups going after that space. On the smart speaker side, we haven't really seen anyone. Very few startups building on top of the Alexa. Even on the Alexa Skills, which is the equivalent of app on a smartphone, we haven't really seen any pitch of startup going after that. So call me a little bit of a skeptic on that kind of home smart speaker area, where we haven't really seen the ecosystem of app developers going after them. And even as a user or as a potential investor in them, I would be asking them, what is the retention? What is the engagement with those? I mean, I've had one for 6 months, and it's basically kind of catching dust on the cupboard.
Mine's a timer, generally.
Exactly. So, and I'm a little bit of a skeptic because of that, because I think the pure voice interface is a little bit too simplistic. You don't really have a feedback of what did it understand, what task can it actually do, and that's the reason why they've been adding a screen now. But now if you've got a screen and the speakers, it's just an iPad that doesn't move. So I don't really understand the positioning of those devices. I do believe voice as a complement to other things, as an interface, but as a simple voice interface device in the home, I'm a bit skeptical.
Mark, talk to us. You go to the app developer conferences for the likes of Facebook, for the likes of Apple, example. How are they just not managing to entice enough developers on board? Why are we not getting the fleet of startups feeding this ecosystem that perhaps Martin would have expected?
That's a very good question, very interesting. But see, their Siri voice platform is not open to developers where, one startup can make a speaker device, put Siri on top of it, and then add their own flavor to it. That's not something that can be done right now. But Microsoft with Cortana and Amazon with Alexa have recently started offering their voice service to be used on other startups' devices. You see Harman Kardon, they're coming out with a speaker in the fall that runs Microsoft's Cortana. There's a bunch of different startups now using Alexa. Alexa. It's going to take time to penetrate, but the bigger picture here, the bigger story here is the services that go with these voice-activated systems. It's what kind of music do you want to subscribe to on the Echo Show. It's what video platform are you going to subscribe to. It's about keeping players to their customers, sticking them together in those ecosystems. The last thing that Apple wants is people to use an iPhone and an Alexa speaker and a Windows PC. The last thing Amazon wants is for other people to use an Apple TV and an Alexa speaker. They want to bulk up their ecosystems and have everyone on their own platforms across their different devices, and the speaker is just one component of that.
That was Bloomberg Technology's Mark Gurman and Martin Mignon of Index Ventures. Now, stories of sexual harassment within the tech industry continue to come out. VC firms and tech startups throughout Silicon Valley have been rocked by numerous sexual misconduct allegations, resulting in several resignations from tech investors, with the latest one coming just this week from 500 Startups founding partner Dave McClure. As the industry's move to grapple with harassment gains momentum, questions still remain on how it can actually enact true change in the male-dominated sector. Bloomberg View columnist Joe Nocera, who has written for the New York Times and is the former editorial director of Fortune, wrote about this topic in his column this week and joined us along with Index Ventures partner Martin Mignon.
It's so pervasive that there are studies out there that show that 60% of the women who were polled said that they had had to deal with some form of sexual harassment. So, I mean, I would say that's pretty darn pervasive. And it had gone on, it's really going on for years, because the power imbalance between a venture capitalist who has money and a female founder who desperately needs money is immense. I mean, it's as powerful as a CEO and an underling. So it's really only recently, especially after Susan Fowler wrote that incredible blog post about her year at Uber, which launched really the decline and fall of Travis Kalanick, the CEO, that women have started to come out and not talk in vague generalities, but use their names, so they're on the record, and name the people who harassed them, the men who harassed them. And there's been an explosion over the last 2 weeks in Silicon Valley over this. And jobs have been lost. And let me just say one other thing. There are going to be more explosions because women are going to keep talking about this, and more names are going to come out, and more jobs are going to be lost.
What I'm fascinated with, Martin, is whether this is something that's been talked about in Europe much. Because from my perspective, I've been in Silicon Valley for a few months, but it doesn't feel like perhaps we're going to get the explosions here that you're seeing in Silicon Valley. Am I entirely wrong?
I'm afraid you're wrong. I think the imbalance of power that Joe mentioned between the fact that there are way more men than women, especially in the VC industry, but also in the tech industry as a whole, is as true in Europe as it is in the US. And this issue of the imbalance of power I'm afraid is going to be the same here as well.
You think, therefore, is it jobs that need to be lost here in Europe and in Asia to start to see the harassment element certainly start to come away, but also the discrimination and the diversity start to even out?
Yeah, I think what's been happening in the past few weeks and past few months has been really kind of a call to arm for the industry. I think it's been obviously a lot of unacceptable behaviors and very brave behavior from these women who've kind of dare to speak up. I think it's been a really good thing, and clearly this item has moved up at on top of the priority list of certainly at our firm, and I'm sure across the industry. At Index we do have 4 female investors as part of the 20 person investor team, which is not terrible, but we should do much better. And we don't have female partners, which I think it's not really a good thing. And we really need to make it as a top priority to expand the female partnership at our firm, and we are taking that really, really seriously.
Joe, I mean, your piece is fascinating. I urge our viewers to go online and read it. But it does take brave women to come out and speak against tech giants such as Uber, to take on the likes of binary 500 startups. But also, we've seen it affect other industries. And yes, maybe we start to see harassment decline. But do we see diversity pick up as well? And are we starting to see all of this coming to change in Silicon Valley?
Well, you know, in a weird way, the harassment is the easy problem to solve because it's such an offense that, you know, if you make the consequence, you're going to lose your job and you're going to lose your reputation. Men will stop doing it. I mean, that's what the other industries show. Gender bias, getting women on boards, getting more women founders, that is much more difficult. Although I will say, I do think one of the reasons that all this has been coming out now is because there are a lot more women founders than there were in the past. There is an increasing number of women who want to get into technology, and I think it's their frustration that is driving some of this, some of these exposés, and could lead to big change.
Now coming up, analysts voice concern over demand for Tesla's high-end Model S and X cars. What does CEO Elon Musk have to show with the upcoming more affordable Model 3? We talk to the man who wrote the book on Elon. This is Bloomberg. Now, after a steady rise in 2017, Tesla stock pulled back this week. Analysts have growing concerns as the company reported deliveries flatlining in the second quarter. Goldman Sachs and KeyBank Capital Markets issued notes saying that the demand for the company's higher-priced Model S sedan and Model X SUV may have hit a plateau. We spoke with Bloomberg Technology's Ashley Vance, who wrote the book on Elon Musk. I started off by asking him how important the company's upcoming Model 3 will be for investors.
We can look at the S and the X sales, but the Model 3 remains this kind of make or break product for Tesla. Over the weekend, we heard from Elon that they're going to ship about 30 Model 3s this month. So the good news is that the car is arriving much earlier than Tesla products tend to arrive. It's almost on time. The bad news, of course, you know, is that they're talking about kind of hand making 30 cars, and this is definitely not mass production like we're used to seeing from other automakers. But really, over the next year, 2 years, it's how the Model 3 sells that will come, you know, that will define Tesla. And if you're an investor in the company, I mean, the only way the share price makes any sense right now is if the Model 3 does very well.
And when we're looking at the slight sell-off that we saw today in Tesla's share price, that seems to also be digesting those numbers that we got very late Monday prior to the US holiday coming from Model S, Model X sales, and they did seem to disappoint. Is there an issue that potentially there's a plateau going on here?
It looks that way a little bit. Tesla seemed to blame some of the lackluster sales on trouble getting a battery pack into production. You know, this has been a concern, though, that's been haunting the company forever, is how many rich people are there that can buy a car that really starts at about $100,000 after you start equipping it with a few things. And you look around Silicon Valley, where I live, I've been amazed to see how many are out there. There's even more wealthy people here than I ever imagined, the same in Los Angeles. But you wonder how this plays out globally, and so now maybe finally that car's starting to stall a little bit, and of course that's where they make their much higher margins than they're going to make on the Model 3, so it's a problem if that stalls out.
Is the Model 3 going to eat into demand there? Do you think would people rather go for a $30,000 car but still have the Tesla finesse to it, or do you think still those who have the money would rather go for the luxury S and X?
No, I think the Model 3 is a definite problem. I mean, you can buy into the Tesla story, into Elon's story, whether you're rich or have less money, and you still get this amazing gadget. Elon's been pushing very hard for people to realize that the Model S and the Model X, these are luxury, high-end vehicles, and if that's what you're looking for, that's where you should go, because he wants those sales to keep going. But I think there's no question that these early adopters, and then just people who are into technology and want to get into Tesla, the Model 3 is going to be the obvious way to go. It's certainly, it is not just a sort of ease down version of the Model S. It is a much lower end car, but it's going to be tough to convince people of that.
And what will Elon Musk be doing to do the convincing? He's a man who takes to Twitter. We know that clearly that is his way of speaking to the masses. But how will he be trying to negotiate these pardon the pun, bumps in the road? Will he be going out fighting? You're the man who knows him and has written on him.
Well, he is relentless about these things. I mean, part of it is just the shine. You know, the Model X and the Model S have become a status symbol of sorts, and so that, I think, will carry on, and there will be people who just want to buy the best thing that Tesla is selling. And then, of course, Elon's going to be out there. He's going to have huge events for the Model 3. And then, you know, we see him on Twitter all the time talking about, yes, we have this car coming, but still think about the Model S and the Model X. And, you know, Elon's relentless about this stuff. And he has this gift that the other car makers don't have, which is that his Twitter account is this immense free advertising. And it's very powerful.
Your gut, do you think they can push forward and meet these very lofty expectations that are currently being baked into the share price?
I mean, in my gut, no. Look, Tesla has struggled with manufacturing for years. If we know anything, it's that these shipment numbers almost definitely will come in under, you know, what the company is having us think about. I think with the share price, though, you know, this can't be based on just like a 6-month thing. How many Model 3s do we ship through the end of this year? I mean, it's a 1 year, it's a 2-year story. If the company can make these cars efficiently, if he can make them at high quality, then the Tesla story gets very good. If they struggle over a long period of time, it's a huge issue because, you know, all their competitors are coming with electric cars. Their quality is very high, and so every month that ticks by is at Tesla's disadvantage. But you know, it's an 18-month, it's a 2-year story that we're looking at.
And Elon, of course, remains #1 shareholder in Tesla. He's got more than 20% of the company. He's clearly got skin in the game. But do the investor base, do those out there, those sitting around you in Silicon Valley, ever worry about, well, the fact that he's got so many other distractions, looking at SpaceX one day, looking at the Boring Company the next? How much do they really consider that he can continue to remain so focused?
I mean, I think people worry about this, but if we've seen anything over time, it's that the companies seem to actually be getting better at delivering on all the things that Elon promises.
Now, coming up, Amazon's deal to acquire Whole Foods is already shaking up the grocery market. What sector will the tech giant disrupt next? We'll discuss. And if you like Bloomberg News, check us out on the radio. You can now listen on the Bloomberg Radio app, Bloomberg.com, and in the US on Sirius XM. This is Bloomberg. Amazon's decision to acquire Whole Foods market took many by surprise, so much so that we continue to question which industry the tech giant will disrupt next. Modesto Crespi-Hart analyst James Chalkmark thinks that Amazon can extend far beyond delivery and encroach onto the territory of restaurants and the entire prepared food and delivery market, doubling up on the grocery opportunity. Chalkmark discussed his outlook with Eileen Burbidge from Passion Capital.
There's no way that my thinking and our thinking is in line with what Jeff Bezos is thinking. He's probably several steps ahead. So in thinking about that, you know, where could the opportunities be, and really just thinking about how they could leverage the Whole Foods infrastructure as it stands today. Here are a couple things that we know. The restaurant business is an $800 billion industry, which is bigger than the $700 billion grocery market. Digital penetration of digital food sales is at over 20% in China versus just 2% in the US, and then the margins are ripe for the taking in terms of prepared food. So you put that all together, we think we could be in a situation where Amazon can leverage their data, their analytics, and actually predict the kind of taste preferences, the palate of each and individual market, leverage the infrastructure of Whole Foods to act as a commissary, slash the margin to 0%, and then deliver, you know, potentially celebrity chef tied-in dishes, you know, for $5 a pop, and for Prime members. So I think, you know, it could potentially open up a whole new array of food services beyond just delivery and beyond just grocery.
Wow. I mean, Eileen, you were just talking about, as a seed investor, perhaps it's not the time to be going into food delivery companies, even though it might be the time to be looking at Deliveroo or Delivery Hero that just IPO'd. But As a seed investor, I mean, do you see this sort of potential for the restaurant chains themselves to be hugely disrupted by technology delivery?
Yeah, absolutely. I mean, I completely agree with James, and I also think there are other categories that maybe Amazon might go into for bricks and mortar stores. I don't think it's going to end with food. I really think, as you know, James was saying, it's all about the infrastructure, it's about logistics, and it's about supply chain. And there are a lot of other categories, vertical categories, where I believe Amazon can go retail, bricks and mortar. I think as a seed investor, and because we do predominantly tech, I'm probably even less of an idealist and probably less visionary than even James and certainly Jeff Bezos, but I think a lot about what Amazon's done on the very back end of everything. So not just logistics for goods, whether they're food products or otherwise, but everything they've done for storage, cloud hosting, and everything else. And AWS to be a business that's already into the billions a year, I think there's a lot more that they can do even on the back end that'll start to surprise more and more people as well too.
So James, when you're looking at Amazon, and obviously you do, give us where you see the potential in terms of price target, where you currently stand on the company, and also talk a little bit about not only the restaurant area, but some of the other sectors that Amazon could disrupt.
Yeah, so we're neutral rated. I'm not taking a position on the stock because of this regulatory overhang that we talked about. But theoretically, you can easily make a case for the stock to move at least 50% higher from here, just based off of where the numbers are, because the margins are improving into AWS, and then you have theoretical margins on the retail side as those businesses scale as well. However, you do have that overhang. But as far as the next avenues that they can pursue beyond just food, I think healthcare, personal care products is ripe for the taking. Potentially see an acquisition on that front. I mean, that's another massive industry. Just think about drugs and all the personal care products that you have that's partially being fulfilled on Amazon, but it could definitely be taken to a whole nother level.
I mean, I'm just typing in analyst recommendations on the Bloomberg, and you just see how many buy ratings remain on Amazon, how few sell ratings there are, and how their price just continues to escalate as we continue to see even price targets just slightly continuing to be higher. If we're on the white line, these are where we're seeing currently the likes of the 12-month price targets showing up on the Bloomberg. With the yellow line, we're seeing where the price has been, and that sell-off just hitting Amazon slightly, but we're certainly not seeing any sales coming from the analysts, Eileen. And do you have the regulatory overhang worry with Amazon? Do you think Amazon actually is continuing to become the behemoth that we view it?
Oh, I definitely think, given what we've seen and everything we've been talking about earlier, that they are going to be surely sort of in the eyes of what the regulators are looking at, because they're just one of the ones. It's really obvious. I think they have so much consumer data. They have so much transactional data. They're starting to get into drone type delivery. I think there will be privacy issues. I think that there's a lot of ripe fruit there for regulators to look at if they want to. And to James's point, if the regulators are just doing this really to try and pick any battle just to try and bring the companies down a bit, there's definitely going to be a lot of material there for them.
Eileen Burbage of Passion Capital and James Chopmock of Monesk Crespi Hart there. And finally, Facebook, Twitter and the parent of Snapchat want to be able to show video clips from soccer's World Cup next year. That's according to people familiar with the matter. Now, the companies have offered 21st Century Fox tens of millions of dollars for the online rights. Fox holds the US broadcast rights for the World Cup. And that does it for this edition of Best of Bloomberg Technology. All next week, we'll have special programming on Bloomberg TV, radio and the web for our Focus on Tech Week. Tune in for deep dives into the big issues in tech right now, plus interviews with top industry leaders. And remember, all episodes of Bloomberg Technology are now live streaming on Twitter. Check us out at Bloomberg Tech TV weekdays. That's all for now from London. This is Bloomberg.